Rivian, the EV startup once worth north of $110 billion, just reported one of the worst EV earnings reports in history. The company announced net cash flow of negative $5.2 billion for the full year 2022, while producing only 24,000 vehicles, well below their 25,000 estimate. Rivian stock is now down almost 20% over the past few days, which is leading to many questions on Wall Street about whether or not Rivian's cash burn is a serious problem. Is this something we should expect from a high-growth startup that is ramping up production so fast, or is this something the company can improve on, and if they don't do it, how fast will the company lose money? Well, that question is exactly what I want to address in this video, but as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So, a couple of things I want to mention first. First of all, I don't have any position in Rivian Automotive. I don't own any stakes in Amazon stock either, because obviously right now I'm assessing the situation. I did cover Rivian in its IPO back in 2021 just to understand why the stock at that time ran up so much, which turned out to be a complete fad because the stock is now down over 85% since then. But I'll be honest, there is an opportunity brewing in all the pain we're seeing around Rivian. Yes, the company is struggling, they are making more and more losses with each vehicle they sell, but the company clearly has a very strong moat with their product. It clearly targets a very niche market in North America, and looks like right now they're the only mass production EV pickup truck maker apart from Ford. They also have some really strong tailwinds that other EV startups simply don't have. Not only do they have a multi-billion-dollar investment from Amazon, but they also sell the Amazon delivery vans, which obviously are a massive decarbonization effort. You cannot ask me to count how many startups we saw over the past few years come onto the market that wanted to sell commercial vehicles. Lots of delivery vans, lots of trucks, but Rivian is now the only company to have made it to the other side for those plans. Amazon is obviously their only customer right now, but there is nothing holding back from the company to start selling the same production line asset to other businesses, because obviously Rivian manufactures this vehicle in-house without any supervision from Amazon. But obviously that is just all speculation from my side, so now just actually look into the numbers and understand what Rivian did in the earnings report and what they're trying to hide from most investors given their new shareholder letter. First of all, one of the interesting things they mentioned is the 400-mile battery that they want to launch in the second half of this year. Now this is interesting because I heard the Rivian R1T initially was supposed to come out with a 400-mile pack, which means either they're facing supply chain issues or they ended up getting a product that did not meet the initial specs they had laid out in their investor deck. But anyways, if you now look at the financial health of the company, you can see there were some key mistakes made by the management team in 2022 that these guys are definitely taking on for 2023. Primarily, they said that in fiscal year 2022, they realized a significant gross profit of negative $3.1 billion, which is primarily driven by lower cost or net realizable value of inventory charge. This means the company is not able to write up their inventory that they're producing, because obviously right now they are delivering less vehicles than they're actually producing. This means they're building inventory, which is okay for a startup to do, and it's important to fill pre-orders as fast as possible. But the whole idea of holding inventory in the first place is that you should be able to write that off on your income statement. But it seems like Rivian either mismanaged the write-off process or they estimated the value of their inventory to be a lot higher than it actually was. But the most important thing they mention is that they don't expect their gross profit to improve just with these realized losses decreasing. Instead, they expect their economies of scale to start setting in, which should help them reduce their cost of goods sold per vehicle. And that right there is actually a really important concept many people don't understand. The reason why Rivian's gross profit is so much lower than competitors like Tesla or Lucid Motors is because the company is manufacturing their vehicles in a plant that can produce north of 150,000 per year. You can see that in the fourth quarter of 2022, they sold around $663 million worth of vehicles, but their cost of making those vehicles was over $1.6 billion. This means if they're selling a car for $80,000, they're spending more than $160,000 to make that car, which means they're basically losing money on each vehicle they produce, regardless of how much they charge the end consumer. And although, yes, that is a concern in the short term, I don't think that is going to be a longer term problem for this company, which in my opinion is already run by very, very smart people. That's because the Normal, Illinois plant that Rivian is building these trucks in is a massive production facility at which right now it's running at less than 20 to 15% capacity, which means the cost of their factory and the equipment and the tooling is being currently spread over a lot less vehicles than it would ideally if the company was running a full production capacity. That naturally means their cost of goods sold is going to be much higher for each vehicle, which is going to hurt their gross profit and reduce their gross profit. But it isn't necessarily a sign that the company is doing something wrong. Over the long term, we could find out that the company is misexecuting if they don't turn a gross profit within the next 2 years as they ramp up production. But right now, this is just something a startup has to deal with in the short term, and Tesla went through this very clearly in 2010 and 2012. As a matter of fact, the Tesla Fremont factory, which was actually bought from GM and Toyota, only had a production capacity of around 20,000 in 2013. This means Rivian is investing in a magnitudes bigger factory at a much earlier stage than Tesla was back then. It's a big reason why Tesla's gross profit back then was likely in the positive because, again, they were producing 5,000 cars from a 20,000 factory. Rivian right now is producing 15 to 20,000 cars from a 150,000 factory. And I hate to be trying to cut Rivian some slack here, but let's be honest, even Tesla faced delivery issues in 2012 after they revised their target down to only 2,500 cars for the entire year. For perspective, Rivian delivered around 20,000 cars last year, which obviously was their first full production year. And yes, 2012 was indeed the first full production year of the Tesla Model S. But to answer the question about Rivian surviving the next few years, can they avoid bankruptcy? In my opinion, yes. There's a really high likelihood this company does not do anything material with Chapter 11 filings over the next few years, mainly because they're sitting on north of $11 billion in cash and cash equivalents. That is almost the market cap of most EV startups on the stock market. Not only that, but their debts are significantly lower even after a massive production year of only around $4 billion, with total assets to offset that of around $17.8 billion. And when it comes to liquidity, which is essentially the 12-month runaway the company has, in the next 12 months they owe around $2.4 billion, but they can convert around $13.1 billion into cash to be able to cover that. That means the company has almost a 3 current ratio, which is much better than Tesla or most EV startups in the space, including Lucid. So, what do I think is the bottom line on Rivian? I think this is actually a really attractive investment opportunity. The fact that they're going to slow their production for 2024 and 2023 means, yes, that's going to produce less cash burn. And the fact that they're learning from their mistakes, whether it be their recalls or their inventory write-downs, is going to be an informed factor for the company to improve free cash flow. The company is better capitalized than most other EV companies, and even if their gross profit is very much in the negative, it is for some very understandable reasons. They have a great Rivian Amazon electric van business, which obviously is scaling up and helping a company reduce emissions in very valuable scenarios. And interestingly enough, even after the massive decline in the share price, Amazon still owns around 2 to 3% of Rivian outstanding shares, unlike Ford, who ended up selling out late last year. Although the product is facing some issues with recalls for an early stage startup, it is still a very premium vehicle, resulting in some high satisfaction from most customers. Right now, we are in a recessionary phase with reduced spending, meaning people are going to spend less money naturally. With inflation being at over 6 to 7%, it makes sense why supply chain issues could be hurting the company's production output and also ending up hurting consumer demand. But obviously, we have to wait out and see how 2023 plays out if you really want to make any material investment or understanding of Rivian's business. The stock itself is now trading at only a book to value of 94 cents with a price to cash of only 1.15. The current ratio of the company is fantastic, meaning they're very liquid for the next 12 to 24 months. And the market cap is obviously down significantly from where it was this time last year. I certainly think there are interesting tailwinds for the company ahead, which does make this something I want to keep on my list for 2023. As usual, guys, let me know your thoughts down in the comments section below, and I'll catch you guys in the next one. Take care.